Hit it.
It's Friday, February 9th, 2024, episode 232. I'm Patrick Ceresna.
And I'm Harris Kupperman. Kevin's away this week, but we'll be back next week as usual.
Well, this week, we welcome Brian Nick to the show for a pre-recorded interview with Kevin. Kevin and Brian have a fascinating discussion about how the market is giving up on the idea that higher rates are going to cause an economic slowdown just at the point where Brian's research is showing it's most likely to happen. Then Kuppy and I will talk some charts while trying not to spill our beers, so stick around. We have a fun show. Danny, hop on. What beer are we drinking today?
Today, you are drinking Juiced Seagull, a refreshing wheat ale with natural citrus and banana flavors, jacked with a burst of berry from fresh tropical blood oranges. Pump up your taste buds with Juiced Seagull.
That English accent makes it sound so much better. Let's find out.
Better.
I'm judging you for this beer, though. I don't know how I feel about it, but
It's actually drinks very light. And it doesn't pop in your, the blood orange is not that dominant, actually.
Yeah.
Well, listen, we'll talk about it after, at the end of the show. Let me just quickly get a disclaimer in here. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much market huddle may include natural gas nausea, oil bull butthurtitis, and
I'm suffering.
and prolapse rectum turtlehead chart syndrome. All right, let's get the interview with Kevin and Brian on. I'm Kevin Muir, and it's our great pleasure to welcome to the show Brian Nick. Brian is from Trahan Macro Research. Have I got that right, Brian?
You do.
I do. And, it's a real pleasure having you on the show. You're our first person from your shop. Why don't you just tell us a little bit about what you guys do and how long you've been in business and a little bit more about Trahan?
Absolutely. So people might recognize the name Trahan. Francois Trahan is the only macro research strategist in the Investing Hall of Fame, in the Institutional Investing Hall of Fame. He's been doing this for a very long time, has a framework he's built out over time. We could talk more about it as we go. I'm sure we'll get to the economy and the markets. But what Francois is doing these days is continuing to put out weekly research, which I'm contributing to. And also, we're just getting off the ground a 3-level macro specialist designation curriculum. We're finishing the 3rd level now. 1 and 2 are already live. And it's basically, think of it as sort of a top-down CFA, where we go through what happens with the Fed, what happens with rates, ways to monitor the economy, leading indicators, lagging indicators, and then we get into equity sectors, fixed income markets. And then the 3rd level that we're building out now is all about quant and how to invest with sort of single security analysis in mind through a macro framework. So that's really like the big push right now that differentiates us from a lot of the other kind of research shops.
Well, it's fascinating stuff. And Brian, I had the good pleasure of watching you and Francois speak in Toronto. And one of the things that I loved about you when I kind of heard you speak was the fact that you've actually worked at the Federal Reserve. And so we're going to get to that, and we're going to get a little bit more about your background. But first of all, did you know you always wanted to do this growing up? And where did you grow up? And at what point did you realize that you were destined to be a macro strategist?
At some point, I must have transitioned from wanting to dig up dinosaur bones for a living to wanting to be a macro strategist. There might have been a few other stops in the middle. In truth, I did very little economics before I got to college. It just wasn't offered. I know these days I interview kids a lot who are applying to college, and they take all these wonderful courses, macro, micro, government, and none of that was available. So my first exposure to economics was really in college, and I just really took to it and enjoyed it and wanted to find a practical application. And that's how I ended up at the Fed. I was sort of a government economics dual major, and then what better place to bring those two things together than work at a central bank?
So now, where did you go to university?
I went to Dartmouth College in New Hampshire.
Okay.
Long time ago.
And a long time ago. I know that feeling. And how did you get the job at the Fed? Did you come straight out of school, or did you intern there? I'd love to hear kind of more of the story of how you ended up there.
Yeah. So I knew a couple of people from some internships I'd done who were kind of ex-Fed people. And they told me hey, you want to work at the Fed because when you leave the Fed at some point, people will assume you're really smart, maybe even a little bit smarter than you are, simply because you work there. And I actually have found that to be the case. The Fed goes in and out of vogue. Sometimes people are down on it. But generally people are like, oh, you worked at the Fed. So it was right out of school. I interviewed to be a bank examiner, which I had no idea what that was. And I think they realized that I didn't really know what that was either. So they said, why don't you interview for the markets group? It's sort of a more direct translation from what you've done in undergrad and some of your internships. So the markets group ended up being an awesome place to work, rotational program for people coming out of school. I still highly recommend it. Back when the Fed was targeting the Fed funds rate on a daily basis, I was helping them do that. Seems kind of quaint now in the era of more than ample reserves.
Right.
But that was just an awesome place to work. Learned a lot from the people who worked there, and got spit out in 2008 into the private sector. Wanted to venture out, and ended up working for a firm called Lehman Brothers. I don't know if you've heard of that one. So it wasn't the best exit strategy.
Your timing was a little off.
Impeccable, yeah. February 2008. Yeah.
Oh, nice. So you were you were actually at the, if I'm not mistaken, the markets group is part of the New York Fed. Is that correct?
Yeah. So every Federal Reserve has an economics department, but only one Federal Reserve Bank has the markets group, which is a good thing. And that was at the New York Fed. Yeah.
And so when you say the markets group, that's the group that would be doing the quantitative easing, that would be buying and selling the bonds and doing all of the actual financial transactions. Is that correct?
Yeah, I left just when it was becoming really interesting. When it was basically the entire portfolio was a ladder of Treasury securities. I still remember the amount. It was $787 billion because I was on the staff that was in charge of just like making sure the rollovers happened cleanly. This is before QE, QT, all the other great toxic assets they've been adding over the last 15 years or so. Their balance sheet is a lot more interesting now than it used to be. But you learn the kind of the nuts and bolts of how the Fed works. And that's been extremely helpful, obviously, as the Fed has become a bigger and bigger player in really, at this point, I would say the daily moves in financial markets. So yeah, I guess it wasn't quite as creative back then. They were still envisioning zero interest rate policy as a thing that could happen theoretically one day, but they weren't there yet when I left.
You touched upon it when you said that you talked about the ample reserves and the fact that the Fed did not have a balance sheet. I was wondering if you could take some time to just explain to people how we've changed from a scarce reserve system and how the Fed actually used to have to go and buy and sell T-bills to change policy rate to this current environment. Obviously, once we hit the zero bound, we were kind of had to go from the scarce to the ample reserves, and kind of how the plumbing might work. Because I think a lot of people probably don't realize the kind of enormity of that transformation that happened in 2008.
Yeah, so I love to talk about this at cocktail parties and people just walk away. So thank you for giving me the opportunity to share it on this podcast. So back in the day, I would say this is maybe in the early to mid 2000s, the Fed still micro-targeted the Fed funds rate on an overnight basis every night. And one of the things I was really curious about, interested in, surprised by when I joined the Fed was when I got there in 2003, they had just lowered the Fed funds rate from 1.25% to 1%. And I just assumed that would mean they needed to add more reserves to get the Fed funds rate to trade lower. Basically, right. You're increasing supply and you're trying to bring you increase the supply of reserves. You're hoping that the rates trade down. But that's not actually what happened. The market sort of just snapped to attention based on the credibility that the Fed had, that if the rates didn't trade where the Fed wanted it to, they would add reserves or take reserves away. Back in the pre-GFC days, the balance sheet did grow. It wasn't quantitative easing, but the balance sheet grew because the liability side of the Fed's balance sheet includes currency in circulation, green paper money. And that grows over time because the size of the economy grows over time. And so the Fed has to have its assets grow over time. Otherwise, you'll end up draining the banking system of all the money. Essentially, all the money in the banking system will leave banks and turn into green paper money, and the Fed doesn't want that. So the Fed had to actually go out and do the open market operations maybe once every 2 weeks. They had to add a couple of $1 billion here and there. And then on an overnight basis, they were using the repo market to add anywhere from $500 million to sometimes maybe 15 or 20 billion when there was a lot of liquidity need on an overnight basis. So they were using that amount to micro target, within a few basis points, the Fed funds rate every single day. GFC shows up and it's clear that the overwhelming need in the banking system is just more liquidity. And so the Fed takes an approach where we're going to cut rates to zero. And then once we do that, we can't cut them into negative territory. The ECB tried this. It hasn't been a huge success. And instead of doing that, we're just going to do open market operations times infinity. We're going to flood the market with reserves. We're going to do QE1. And when more was needed, they did QE2 and then QE3. And then a couple of other things along the way to try to try to steepen the yield curve and add more reserves here and there. But that essentially just changed the name of the game for the Fed. There's no way for them to micro target the Fed funds rate on an overnight basis anymore. They can have a Fed funds target rate, but getting there with the repo market when you have trillions and trillions in reserves compared to 787 billion in assets before the GFC, there was just no way to get there. And so they used they started paying interest on reserves as a way to keep money at the Fed and prevent liquidity from running wild all over the system. And that interest payment was envisioned as part of the zero lower bound program that they were contemplating even as early as the mid 2000s before the GFC.
Right. So,
and then obviously after COVID hit, they did another round and even larger rounds of quantitative easing, again, just to ensure that the financial system had all the liquidity that it needed. And we're still, unwinding that.
right. So just to be clear, so in the scarce reserve system, they had the exact amount of reserves that was the market kind of demanded, and they supplied it on as you say, a micro level. They could have, when there's too much, they drained it, and when there was not enough, they pushed some in. And then once we hit this abundant or ample reserves, they were like, we're just going to flood it with all the reserves that the system needs. But if you do that, then interest rates would actually fall lower. So they put interest on excess reserves to basically put a floor under the bottom. Is that correct?
Yeah, the interest on excess reserves effectively creates a magnet that keeps money at the Fed as opposed to just causing it to circle wildly around the financial system on an overnight basis, and that would ultimately drive interest rates too low.
Right. Now, one of the things that I think is interesting is the fact that they did this in the GFC, and they didn't really. It was kind of a necessity, but then when we got onto the other side, they never thought about going back to a scarce reserve system. We've kind of just accept this corridor system, I think is what they call it, or the ample reserve system. Do you think that's strange? Or do you think it was just kind of it was the way modern central banks were headed?
So I think the Fed, and I guess we're really talking about 2018, 2019 here, is when the first round of quantitative tightening, which didn't last very long and didn't tighten that much, as the Fed was trying to normalize its balance sheet. I guess that's the euphemism. They would say normalize its balance sheet as a percentage of GDP, and you can look at it all different kinds of ways. But they were doing shrinkage in assets. So instead of treasuries rolling over on the balance sheet and replacing those with new issues, they were just letting a lot of them roll off, and the balance sheet was shrinking. And what happened around that time is, again, the Fed doesn't know exactly what the right level of reserves here is. The post-GFC, banks just hold a lot more cash. They want to hold a lot more liquidity because of all the rule changes, but also because of the lessons learned from the GFC. So getting back to that previous percentage level of reserves, to call it maybe 8, 9, 10% as a percentage of GDP, is probably far, far too low. Where we were just after COVID, late 2020, was probably almost certainly way too high. And they're just sort of fumbling around in the dark, trying to figure out where the right level is. And they're continuing to do QT. So even as we're talking about interest rate cuts, they're continuing to shrink the balance sheet. So those two things happening at the same time is a little bit strange to me. But they're still not done winding down the balance sheet. And I don't think they're going to be done for at least another couple of months. The question is, would they rather stop short of where they think the final target is and sort of let themselves grow into that, let GDP sort of rise to meet it a bit, or do they want to keep shrinking until something breaks? Back in 2019, there was a momentary liquidity crisis in repo markets. There just wasn't enough cash to go around to finance all the collateral that the banks needed to finance in the repo market, and that ended up being, at least a memorable crisis moment in the markets. And that told them they had gone too far, and they stopped doing QT right around that time. Also happens they were cutting interest rates around that as well. Right. So I think we're probably close to the end of QT here, with the balance sheet still a lot bigger than it was pre-COVID, and certainly bigger than it was pre-GFC. And I think that's the Fed's going to be comfortable with that.
But one of the things, though, so I agree with all that analysis, and I think it's spot on and terrific stuff. But in 2016 or 2015, when they finally decided, okay, the GFC has gone by, and they had the opportunity, they could have said, let's get ourselves back down to a scarce reserve system before we raise rates and go back to the old system. But yet they didn't. They actually increased the interest on excess reserves level, and they actually changed the system. And I just think it's interesting that we changed the system and we don't talk about it very much.
Yeah, they really replaced. I mean, I know that money markets staff that I worked on is still there. They replaced a lot of that kind of effort as a kind of an overnight basis, and there'd be these like 2-week operating periods where banks, have to fulfill reserve requirements on average over a 2-week period. So your strategy, if you're the Fed, for managing reserves over that 2-week period changes as you go through it. They're not doing that anymore, and I think what they're satisfied with instead is that they're going to have interest on reserves. And they're going to have a lot of these other kind of large windows. Notice they've been trying lately to, I think, destigmatize the discount window a bit more. I think they want to have the liquidity provisions be sort of an as needed basis, as opposed to them having to decide every day, okay, like how much are we gonna give to the system? They want it to be, if you need help, you come to the Fed and we will lend you money for some collateralized, loan overnight. Or if you need it for longer, like the bank term funding program from last year that's about to expire, we'll give it to you for a year and we'll just charge you a different kind of interest rate. And on the liability side, there's the reverse repo facility, which wasn't used much at all when I was at the Fed, which is basically a place for people to stash treasuries overnight to stash cash overnight in exchange for treasuries from the Fed. And those facilities seem to be what the Fed is okay for now using to sort of, again, I won't even use the word micro target because they're not micro targeting anything, but to sort of just keep the repo markets and the money markets sort of well lubricated enough to continue functioning, backed by, as you say, a very large quantity of excess reserves. And I still think that once they stop doing QT, what they're really keying on is reserves as a percentage of the size of GDP, and GDP will continue to grow. I mean, not always. I mean, we could talk about our outlook for the economy in a bit, but in general, GDP will grow, and the size of the Fed's assets will not grow by as much, and you'll see that relationship potentially normalize over time. This is actually what happened after World War II. The Fed never did QT after World War II, after adding tons of liquidity during the war to keep the treasury rates down, and the economy just sort of grew into the balance sheet after that, and the Fed never had to shrink.
Okay. All right. So you're at the Fed, and then you go to Lehman, and that obviously doesn't work out. But then,
well, it worked out as well as it could. Yeah.
And you end up at UBS. So why don't you tell us a little bit about what you did there and what that experience was like?
Yeah. So the wealth management arm of Lehman Brothers was actually one of the only ones that came out looking okay from the crisis. Ended up getting spun out into Barclays Wealth, but then a lot of the people on the team I was with there ended up going to UBS Wealth Management. And, we're doing sort of macro strategy. I've always been sort of I always describe my job hasn't changed that much over time. Gotten a little more senior, a little more independent, probably a little more confident in some of the views. You see enough stuff over the years. You can start to see patterns in how things work and be able to anticipate, I think, policymakers a little bit better. But we were a team there that was catering to sort of the ultra high net worth business at UBS, which was a fast growing business. I think still is by all accounts. And, doing asset allocation strategy, writing about the economy, helping advisors communicate with their clients about why their portfolios were performing the way they were, why the economy was doing what it was, on a sort of a daily basis with like these sort of break-in blogs that we do, but also obviously writing longer term white papers, thought pieces, again, just to try to support that business. And it's interesting, you're a lot of times when you're in that business, you're competing for mind share with the advisors with a lot of the outside research firms, which is where I am now with Trahan. Like, we would be kind of coming in and talking to financial advisors, and then I'd be talking to them internally and be like, whoa, what about these guys? These guys have a completely different view. So even when you're part of the home office, you're sort of competing with everybody else out there for mind share among the financial advisors there.
And from there, you go to Nuveen. And what's that like? Is that's a move more to the buy side or no?
Yeah, I would describe it that way. I mean, it was Nuveen is the asset management arm of TIAA. Which people probably know is sort of if you have any teachers in your family or people who work in public education, that TI is probably in charge of their retirement fund and their annuities that they have coming due when they're going to retire. And that was, Nuveen's obviously a huge asset manager, manages everything from farmland to municipal bonds and everything in between. And my job there was sort of to represent sort of the top-down view for the firm and to, again, try to help the portfolio managers and the clients kind of understand what was happening in the world and help them inform their investment decisions.
All right. So let's talk a little bit about the market in general before we get everyone upset with the more Fed talk, because I do have some more talk that I want to chat with you about.
Go on forever.
That's right. But most people aren't as interested in the Fed plumbing and all that stuff as I am. So we'll go a little bit about the market. In a recent report, you said, we know we sound like a broken record at this point and stand out from the rest of the strategy crowd. That said, we expect 2024 to remind much of Wall Street how significant interest rates are to the economic equity outlook. Shout out to Milton Friedman. All right. In essence, if I get your argument correct, it's like the long and variable lags are there and everyone's just forgotten them. And this is no different than most other cycles. Is that correct?
Yeah, I guess we're not going to get completely away from the Fed, because this is really what our framework is based on. You can call it a monetarist framework, but the idea is that changes in interest rates have a pretty well-defined impact on changes in the business cycle, changes in the economy, changes in markets, and those changes affect everything else with a different kind of lag. So that typically when you see a move in rates, like the Fed started raising rates in March of 2022, it takes about 2 years from the start of that tightening cycle to start to affect the economy, at least the largest sections of the economy, like the consumer, like the labor market. And so what I think a lot of people were expecting last year in 2023 was this, the consensus view felt like it was a recession, but that would have been well ahead of schedule. That would have assumed the long and variable lags that we think are long but not variable, really, that just didn't apply this time around, or where they would be canceled out by something else. Like a lot of people had excess savings, or something with the pandemic that was going to kind of cancel out the effects of interest rates. But I think we are slowly but surely seeing that pressure that the Fed applied really from March of 22 through the middle of last year by continuing to tighten monetary policy. We're starting to see some of the cracks emerge in what we call the wall of comfort, the things that keep people bullish on the economy, bullish on the stock market, because again, we should only now be seeing the bulk of the effect on economic growth, on employment, on consumer confidence that derive from the changes in interest rates that we've seen. It's one of the largest and most sudden and most shocking and unanticipated tightening cycles we'd ever seen, and to think that there's not going to be any effect, negative effect on the economy, to us seems, I won't say hopelessly naive. I guess I just did, but seems far-fetched, I guess is the better way to say it.
And so do you think this is something that the market just does every single time, thinking that, oh no, the Fed's going to raise rates, but this time is different, we're going to achieve the soft landing? Like, is this almost like Charlie Brown with the football?
This literally happens every time. And there's a number of ways to look at it. What I'd say we're in right now is what we call a Fed relief rally. So the Fed stopped raising interest rates in July of last year, but really only told us it was done raising interest rates in the fourth quarter. So the market initially did not rise following the last rate hike, because the Fed, I think itself, didn't quite know if it was done. And then it only took a few more months of inflation coming down for them to be convinced. So we're only a couple of months now into the Fed relief rally. You see it every time. The average sort of rally that you see following the last Fed interest rate hike in the next 6 to 12 months is significant. It's in the order of 10, 15%, and that's kind of what we're seeing in this cycle as well. Other ways of looking at it, and all those Fed relief rallies end around the same time, which is when the Fed starts cutting interest rates and earnings estimates begin to roll over, and those two things tend to happen at the same time. Another thing you always see is a soft landing narrative emerging in the markets. Even in the middle of 2008, when we saw a couple of months of PMIs were kind of hooking upwards and earnings estimates were moving up, economists in the middle of 2008 were revising up their growth forecast for the year because it looked like maybe we're out of the woods. Obviously, we weren't. And even if you look at kind of just a very simple measure like how many people are searching on Google for soft landing versus recession, or how often is the term soft landing showing up in sort of financial news articles, there's always spikes right before the recessions hit, because there's always a sense that this time is different and we've achieved the soft landing. So this time, I think the echo effect of more outlets, more social media is creating an even more kind of fervent belief that it's a soft landing, but we don't see much different in terms of the pattern in interest rates and what it's doing and the grinding effect it's having on different measures of economic well-being than we did in prior cycles.
Okay, so you mentioned there the fact that even though the last hike was a while ago, it seemed to be that the Fed was still tightening. And I agree completely. Like, they were threatening to tighten for a long time. So do you think that we should really be measuring the point of the last hike from almost the period at which the Fed finally acknowledged that they're no longer going to hike, or the actual last hike?
Yeah. So when we look at changes in interest rates and use those to forecast GDP, we tend to look at longer term rates. Some of this is just because of the long period where rates were at zero and there wasn't any volatility with the Fed funds rate or the 3-month bill. So I would say and again, and this is this is usually not a consolation for any of our readers or clients, but we can now, I think, with some confidence, date where the bottom is going to be for the economy after the next recession. And that tends to be 2 years after the peak in the 10-year rate. So we're really looking at the beginning of October or around there as that was the peak in the 10-year where I guess we would sort of date the end of the tightening cycle. And again, that was not exactly when the Fed stopped raising interest rates, and we can argue about their communication strategy, but we would kind of put 2 years from there as the likely bottom for the economy, which would put us about, end of Q3, beginning of Q4, 2025. So long way away.
Okay, so I would agree that was the point that they pivoted and said, like, up until that point, like the September 2023 FOMC meeting, they were still talking about raising rates, and that's what caused the backup in yields and the long end to go no bid for that month. And it wasn't until kind of that point that Powell actually made the pivot and said, hey, wait, it looks like the long end's doing some of the tightening for us. And they shifted. I would love to kind of talk about your experience with the Fed and whether you think that was, did they expect that? Was that a mistake on their part? Like I'd love to hear your opinion about how the Fed has stick handled this entire tightening cycle.
So I guess this would put me wildly out of consensus, but I think the Fed ultimately raised interest rates much too far and much too quickly. And part of that is that I think what they started to focus on in 2022, there was that meeting in the middle of that year where Powell started to pivot to looking at headline CPI, which is at that point was being 100% driven by oil prices as sort of a thing that he needed to bring down. And it's possible that the Fed's, I call it the summer of 75 in 2022. I don't know how many Billy Joel fans are out there, but when they were raising 75 basis points every meeting, that may have contributed to certainly slow down the housing market and construction, may have contributed to decline in oil prices if everybody at the same time thought we were going to have a recession, which it seemed like they did. But ultimately, the Fed doesn't target headline CPI because they can't. And oil prices ended up coming down very quickly. And the fact that they were still raising interest rates, into the second half of last year, to me, was a mistake. And they didn't need to go that far. And it was obvious, as early as April or May of last year, that inflation was coming down and was going to continue to come down quite quickly, given, I think, again, because we focus on inflation as sort of a lagging indicator, it's not that hard to forecast. You can look at things like what was happening to the quits rate in the labor market, what was happening to apartment prices, which is a huge kind of oversized part of CPI, and to a lesser extent PCE inflation. So there were these things that I think we knew were going to bring inflation down, and they have certainly brought inflation down faster than the Fed thought and faster than the markets thought. And so I don't think those last couple of rate hikes were necessary. And I think we have a section in our outlook, called the Fed's not going to be able to cut rates early in this cycle, because early would have been last year. For them to sort of preempt the effect of rising rates, they would have had to be a lot earlier and a lot faster in reducing their target rate. And what they're about to do now, whether they cut rates in March or May or June, is cut rates about on schedule. They tend to leave rates more or less where they are for about 6 months. At the long end, been a little over a year. That was before the financial crisis. They probably should have cut rates earlier then as well. But on average, like 6 to 8 months between the last rate hike and the first rate cut. And that's about what we're going to get. So the idea that the Fed's going to become riding to the rescue and dramatically change the odds of a recession eventually hitting, we think is misguided at this point, because the Fed is not doing anything other than what it normally does, which is target lagging indicators and react a little bit too late to changes in the economy.
So if you believe that the Fed was too fast, too tight, do you think that increases the chances of a hard landing, like of an accident?
Yeah, absolutely. So two things. One is, the decline you see in economic activity has a very strong relationship to the size of the cumulative rate hikes that happen. And this one, you have to go back to the 1970s to find a tightening cycle that was this, not necessarily the speed, but the magnitude of the rate hikes. This is the most severe one that most of us have seen in our lifetimes, and so that has a one-for-one translation to how much we should expect things like the ISM manufacturing survey to fall, GDP declines. We will be looking for at least a moderate size, if not a more severe recession coming in the not too distant future. And the other thing that you look at is the speed with which they raised rates also it kept the yield curve and has continued to keep the yield curve inverted for a very long time. And the duration of the inversion tends to match the length of the next recession. Not so much about how deep the yield curve is inverted, but how long it stays inverted. And we've done studies that show, for a 12 months or 15 months of inversion, wherever we are at this point, that's about how long you should expect the next recession to last. So I think they have undoubtedly, and they did through their actions in the sort of the second into the third quarter of last year, make the landing that will eventually get harder than it needed to be.
And so is that kind of aggressiveness on the Fed's part of the reason that the market expected a recession so quickly? And
I think so. And I think the Fed itself was saying to expect a recession.
Right. And so where you and the market would disagree is the market's almost given up on the idea of a recession is coming. And you're saying, no, just because it hasn't come yet doesn't mean that this is going to be any different. And yes, it was, and ultimately it will be even worse because they went so far, so fast.
Yes. I think that the reason that recession was consensus last year was, well, first of all, so many kind of disruptive things that happened, right? We had runaway inflation in goods when we kind of reopened post-COVID. We had, the Russia-Ukraine war happened at the worst possible moment from an inflation standpoint, just added to the pain. Consumers, we were seeing what was happening to real incomes turning negative. There's a lot of reasons to be concerned. But if your main concern and the main thing you feel drives business cycles is monetary policy, and with a long lag, you shouldn't have been concerned about the lagged effect of interest rates sending the economy into recession in 2023, because the lags would tell you it shouldn't happen until 2024. You can miss on, a quarter here or there. It's not an exact science, but to say that we should have expected Q1 2023, which is when it felt like a lot of the recession concern was sort of its apex, that would have been well ahead of schedule. And we get questions from clients all the time about, well, didn't we have the recession in 2022? And the first 2 quarters of 2022 did see negative GDP growth, but there's no way you can ascribe that to what the Fed was doing, because the Fed was only raising rates starting in March.
So in essence, you're arguing that the long and variable lags are not as variable as people are making them appear.
Longer than people think and less variable than people think.
All right. Okay, I got it. Now, the other thing about it is that's different this time is that back to the scarce and ample reserves and a Fed's balance sheet, we actually have QT and different parts of the kind of the Fed's balance sheet playing a role in it. And first of all, do you ascribe much kind of influence to like the fact that the RRP zoomed up to $2 trillion and it's back down to 500 billion and that liquidity? Like, is that a factor in your analysis?
So the topic of the RRP and what happened with Treasury bill issuance last year, it's like one of those things that I think is probably only fascinating to me and a dozen or so other people. But I do think what happened last year was interesting from a liquidity perspective. So if you were looking for QT to really sink the economy, and that wasn't really our view, and we just don't have enough evidence or enough examples of QT to know exactly what it should or shouldn't be doing to the economy. We have a sense that because QE was supposed to be good, the QT should be bad. But what happened last year was that the Fed was shrinking its assets down in accordance with the QT program, but you weren't actually seeing liquidity in reserves falling because it was this other thing on the liability side of the balance sheet that I referenced before. And you just mentioned the reverse repo facility that had gotten really, really big when there was no place for money market funds to invest, to drop cash overnight. And the Fed was the only kind of game in town for paying a reasonable rate of interest. To once rates went up by more and the Treasury started issuing a lot more T-bills, there was a lot more other more attractive places to get kind of very short-term, money put to work and to get a reasonable rate of interest. And so the Fed's the draw up and draw down in the RRP facility, I think, came purely as a result of rates having started out very low and then gotten very high, and then the Treasury issuance sort of mirroring that. So that's interesting, and I guess if you were looking for a sharp decline in bank reserves year over year to be an additional driving force behind the recessionary impulse in the economy, you didn't get that last year. Now, we're not very far, as you mentioned, from zeroing out that facility, and there's been members of the Fed's leadership, including Lori Logan, who was at the markets group when I was there, and she's now the president of the Dallas Fed, who have been pointed out that they want to draw that back down to close to zero. And then you're going to start to see QT cutting into bone, so to speak, not just skin. Because that will mean that there's no place for the money to come from other than bank reserves. And that's when the Fed really has to make a call. Do they want this to really bite hard at a time when they're trying to ease policy through interest rate cuts? And I just wonder what that juxtaposition is going to look like and if they're going to kind of veer off that path at the last minute by announcing they're going to wind down QT.
One of the things that I find interesting about QE is the fact that the Fed's well prepared to use QE as a policy tool. In terms of when we get an economy or markets in free fall, they'll stand in there and they'll buy bonds and they'll provide liquidity. Yet they are not prepared to use QT as a policy tool to slow down the economy. Do you think that's a mistake? And where do you think that thinking comes from on their part?
I think they do see an asymmetry, and I think it's probably correct to see an asymmetry in terms of the over provision of liquidity. And you can imagine there's problems with it, right? If you just did QE infinity and just flooded the market and then some with reserves, there are issues that can come from that. But there's an asymmetry that you can add, right? You could add $8 trillion in reserves, and it would have some good effects and some bad effects. But if you take that same amount away, it would only have bad effects. And I think they see the downside risks of adding too much are not as great as the downside risks of taking away too much. So they're going to always be more hesitant. And the same is true usually of interest rates, right? They usually cut rates faster than they raise rates. We'll see if that happens this time around. I think a lot of people are looking for very gentle rate cuts, and that doesn't comport with the history of the Fed. When they cut rates, they tend to cut rates pretty quickly. But with QT, I think that going slow, they don't see a huge downside to going slow. Now, they may have gone too slow for their taste. I mean, not seeing any decline in bank reserves last year might mean that they feel like QT happened too slowly, or it might mean that it was sort of serendipitous and things worked out and they can normalize their balance sheet without affecting the banking system. I don't think they intended to use QE again after the GFC, and then COVID came and was, it was the perfect excuse for them to turn the spigots back on. I think with QT, they really want it to be something that happens in the background, and they want the interest rate, the Fed funds rate, to be the primary, the overwhelming sort of thing that people look to as a sign of whether the Fed desires tighter or looser monetary policy. And the more boring they can make QT and the more they can sort of shove it off the stage, I think the happier they'll be.
Okay, you mentioned the fact that in the past, and especially the last couple of times, the Fed has cut rates really quickly. And I think the market would be kind of shocked if not the market. A lot of people would be shocked if they actually went and looked at the speed of those cuts. Do you think that that's why the front end of the curve seems to run ahead of the Fed every time they start talking about maybe cutting rates?
Maybe. I mean, the fact that the yield curve is still inverted, I think means in general that the market still doesn't think that the Fed is going to move quickly when it moves. I've been surprised that the 3-month and the 6-month bill haven't moved down more and faster. I think it's also there's a sense that the Fed, as long as everybody buys the soft landing argument, there's not really an argument that the Fed's going to need to cut rates very quickly, and they're certainly not saying anything to the effect of, oh, we need to cut rates a lot or cut rates quickly. But again, that's always the case. The Fed, if you look at sort of I call them the algae charts that sort of show the Fed funds rate, and then they have, the futures markets kind of floating up and down at any given time. And again, the Fed and the market are almost always wrong about how fast rates are going to need to move up and how fast rates are going to need to move down. And I think,
but don't you think though, this last time that when they had 7 cuts priced in at the beginning of January or whenever it was, that they were erring on going the other way? Like, don't you feel like there was a lot expected? Like the Fed told you, they came out with the SEP and they said they're going to do 3 cuts. And then the market said, look, the Fed's willing to cut. Let's put in 7.
Yeah. Look, I think if our macro outlook comes to fruition, I think they're going to be doing more than the equivalent of 7 25 basis point rate cuts this year. They might be backloaded as the economy worsens throughout the year, but I think that 7 to us looked reasonable. Maybe not the timing of exactly how it spaced out or the gradual nature of those cuts, but look, I think when you saw 7 cuts priced in, it was sort of happening at a time when the main argument, I think, for why the Fed would be cutting that much was inflation coming down quickly, which I think is still the case. I mean, I had a couple of these surveys like ISM prices paid are showing an acceleration in inflation, but the inflation data itself is still showing, firm signs of slowing. And then the other thing was that the labor market might be loosening up just a bit. And what really was a shock to the system was the January employment report, which really priced out a lot of those rate cuts and validated what Powell had done 2 days earlier, which is to say that March didn't look like a live meeting for a rate cut. And I think what's been interesting is that you've seen those cuts priced out even as the stock market has continued to move up, which to me is, that wouldn't be coming into the year. That wouldn't have been my expectation that you'd see the stock market doing well with less of an expectation of rate cuts from the Fed. What's clear is that those cuts are getting priced out because more people have bought into that this is going to be a happy ending and we're going to get a soft landing, and not because, the Fed's reaction function is wrong or something like that. I think that's when people start to get really spooked, is if it looks like the Fed should be cutting, but it's not cutting, that's when you start to see the market roll over. And that ends up leading to even kind of more urgent interest rate cuts needed from the Fed.
Now, if your forecast does end up being correct, you implied that there was going to be a Fed that's going to be cutting rates more aggressively. Let's talk about what that means for the stock market, how that works out, and then ultimately what you think happens kind of to bonds and to inflation and kind of your bigger picture if you guys end up being correct about the trajectory of the economy.
Yeah, so this is why we're a bonds over stock shop at this point. Because we look back at the history, and when did the Fed start cutting rates in the last couple of cycles? Let's set aside the COVID cycle, which is quite unique. The Fed started cutting rates in September of 2007 and in January of 2001. By that point, you were at or just past the peak for the stock market. So all these things tend to happen at the same time. The economy tends to roll over at the same time as the Fed's cutting interest rates. So they're not early. They're cutting rates basically in line with when the economy is slowing down a lot or going into contraction. And earnings estimates are rolling over along with the stock market. And so if all those things are happening around the same time, we're looking at a late Q1, early Q2 dramatic and readily apparent change in trajectory here for the economy and for the market. So I think the sense that, gosh, the Fed cutting interest rates is going to be great for the stock market, that's what we're seeing now. The Fed relief rally is about the Fed has stopped raising interest rates and they're going to be cutting at some point pretty soon. So the stock market should go up, and we see PEs go up and even earnings estimates move up. By the time the Fed is cutting, that narrative has changed. And we really just think that's a matter of a few months at this point.
And that's June. And so now, given the fact that you argued that the Fed was overly tight and that might cause an above a larger than normal kind of correction to the economy, does that imply that you think that this stock market has as much risk in it as it's had in a long time?
Oh, for sure. Because when you see a drop in earnings estimates, PEs tend to drop too. And we know, and we've been doing a lot of our work recently on market concentration, that the market is being supported by a relatively small number of relatively high growth, but also very high PE stocks. And those stocks took it on the chin in 2022 when rates were going up. And the thing you didn't want to be was a high PE stock or a high growth stock. What we tend to find as we move through the cycle is that growth stocks get hit when rates are going up, and then they get hit again when rates are going down, and risk aversion is becoming the thing that people go to. Because when people think risk averse, they think low PEs, low betas, low volatility. And that tends to lead you more to the defensive parts of the market. So we're talking about, utilities, staples, healthcare perhaps as well. But that is a very different market than the one we're in right now. And so as we see more risk aversion from investors, I think they'll be more attracted to the bond market, even long duration treasuries, which haven't really been a very desirable asset class for a very long time. I think with a combination of relatively high yields and a deteriorating macro environment is going to make them look quite attractive as well.
One of the things that's perplexed a lot of strategists is this kind of divergence between the soft and the hard data. The soft data has gone, so it's terrible really quickly, and maybe that's part of the reason that they expected a recession so quickly. And yet the hard data has been remarkably resilient. I was wondering if that actually isn't a part of your process, because when I'm listening to you, it sounds like it has more to do with interest rates and what the Fed did in terms of setting policy on a monetary level. And therefore, even though the soft data and hard data are not confirming, the reality is it has more to do with the timing of the cycle in relation to the interest rates. Would that be a fair assessment?
Yes. And I think the order we put it in, and this is actually a couple of chapters in level 1 of the macro specialist designation curriculum, is we look at interest rates, which we call anticipatory economic indicators. So even further back than leading indicators. So again, you're looking at 2 years later, a change in interest rates will exert some force on the economy. And then between sort of interest rate changes and GDP changes, you have these other things that step in, like leading economic indicators. So things like the average hourly work week, which we've seen coming down, capital goods orders, which tend to be kind of a leading indicator for the industrial part of the economy as well. Consumer sentiment, which has been kind of all over the place, is another one. And then the ISM has the longest history, and that's been bouncing around, but it's still below 50 and not showing much, if any, signs of strength. So you'd see that in leading indicators first, and then you'd expect those leading indicators to lead and tell you about the coincident indicators, which are things like retail sales, industrial production, S&P 500 earnings growth, and so that's kind of the order that we see things. And then eventually downstream from all that is things like inflation, which is the last thing that tends to turn in an economy. So I think that's starting from our kind of our lodestar, which is changes in interest rates. All those other things sort of flow straight from there.
All right, and so the fact that the hard data hasn't rolled over yet is not concerning based upon your timing of the cycles? Yeah, so if you look at, I mean, we show this graph in so many different ways in our reports, but if you look at the 2-year cumulative change in the 10-year yield, and you move it forward 2 years and you put it against industrial production growth, retail sales growth, S&P 500 earnings per share, or GDP, and lately we've been using GDP and GDI as a sort of I think it's a better estimate of how the economy is moving. All that lines up extremely well, and there's no indication that things are different in this cycle. That we are seeing, again, industrial production growth is close to zero. Retail sales growth has slowed a lot from the peak, in line with the cumulative rise in interest rates. And so, unless and until we see some evidence that things are really kind of diverging and these relationships are not holding, which we would be seeing again in the next quarter or two, this still looks to us like a kind of a classic, start to a cyclical slowdown, start at the beginning of the end of a cycle. All right, got it. Could you explain to us why you think GDI is a better kind of indicator right now than GDP? Well, a lot of it's because of the patterns from last year. So GDP was negative for 2 quarters, and then it burst back up. And really, what we're looking for, and this the Philadelphia Fed's done some good work on this too, as have a couple of other Federal Reserve banks, that because there are different factors that go into the two, and they should be equivalent over time. It makes sense to look at an average. So if I said GDI is better than GDP, I misspoke. It's really that looking at an average, I think, gives you probably a more accurate picture of what's happening in the economy, because at any given point, you don't know what explains the divergence between the two. And Philly Fed's actually found that using a larger weight to GDI has worked better over time at kind of telling you what's really happening in the economy. So we'll get the GDI number for the fourth quarter of last year at the end of this month. It doesn't come out until the second iteration of GDP. And
we think that generally tells a more kind of intuitive story in terms of what it's been doing over the last year or two.
All right, now let's just end with some questions about the Fed. I'm always amazed at people's ability to kind of project onto the Fed things that are very unlikely to happen. Like you'll sit there and you'll see that the Fed funds futures will be 95% chance that they're going to do XYZ. And people will be like, no, they're going to cut this time. And you're like, are you kidding me? I would just love to kind of get your opinion about why you think, or first of all, do you notice the same, that people make the Fed more complicated than it actually is because it's very clear in terms of their communications what they're wanting to express, and then where they go wrong in terms of understanding and interpreting the Fed?
So the Fed definitely looks at Fed funds futures. It's a little bit meta, right? Like, you're looking at what people think you're going to do. And I do think it guides them to some extent in terms of their communication strategy. If you get a lot of people on the FOMC speaking and pushing back, because let's say they think that the market is priced in too high of a chance of a March rate cut. Well, the weird thing about that press conference that Powell gave at the FOMC was that he waited about a half hour to come out with the newsiest item, which is like he didn't think based on that meeting that they were going to be cutting rates in March. And going into the FOMC,
don't you think that was a case that he was expecting the kind of question and he didn't get it? And it's almost like he blurted it out like he wanted to do it, and they didn't ask him because they figured he was too simple and he wasn't going to do it.
But he did it.
Right.
I feel like if you had that kind of news to deliver and you're like one of the most powerful economic voices in the world, if not the most powerful, you can find a way to answer a question by saying, what I took from that, again, this is not insider information or anything I've divined from working at the Fed, but just based on his body language, it feels like he wants to cut rates and he doesn't have the votes.
You think that's the case, eh? Like you actually think he's on the dovish side?
I do. I mean, the way he said it, he said based on the meeting today that he didn't think the base case would be a March rate cut. And to me, what it sounded like is he was sort of sitting back and listening around the table and realized that there was not a consensus on the FOMC to move on this anytime soon. And so I would say that definitely it indicated to me, and even as he was coming out before he said anything about March, indicated to me that the language he was using, that we have a lot of confidence, but we need more confidence. We're seeing a lot of good data, but we need to see more data. Told me that he really thought they were on track to be able to cut rates. I happen to agree. I think if you're looking just at the inflation side, we can talk about the cracks in the labor market. I think that the last report wasn't as wonderful as it was cracked up to be in some ways, but just looking at the inflation side, I think they have enough of an excuse to start moving down, assuming they think their interest rate policy is restrictive, which it seems like a lot of them do. But in terms of the tea leaves and the reading into the Fed, I think what they see is that when there's something that's priced in as sort of an all but a certainty in the coming meeting, if they're not really as sure as the market is, they send out the voices, and the Fed speak starts up. And you saw today, just that as we're recording this, President Mester from the Cleveland Fed came out and said she thought middle of the year or later this year, which could mean anything, right? March is later this year, but so is May and so is June. But again, voices that I think are tempting to push back on the prevailing narrative, which is that the Fed is about to cut rates, if not in March, then certainly in May. And the Fed doesn't want to be handcuffed to that view.
Do you think that there's a problem in that we have almost an open negotiation occurring as all the different Fed presidents and governors speak?
And the negotiation includes the market. So this is the thing. Like if you have a central bank that is doing forward guidance, which the Fed abandoned close to 2 years ago now, just laying out markers for things that need to happen, and then we will do X or Y. This Fed is not doing that. They're kind of living meeting to meeting. And I think that at this point, the biggest change they can exert on market expectations is really about what they're going to do at the next meeting. And it's hard for them to say anything declarative about what's going to happen in May or June. They just want to give themselves flexibility from meeting to meeting based on what the data is telling them, because they don't have certainly a publicly announced framework as to how they're going about making these decisions.
Do you think that that's a good development in the fact that these central bankers communicate so much more than they did, let's say 10, 20, and 30 years ago? Like
There certainly were. Yeah.
Greenspan used to like purposely try to make it so that you didn't understand what he was doing.
And the statements in the Greenspan era were also so short, and they didn't change at all. Not a word, meeting to meeting, for a long periods of time. Maybe 2 years would go by where they were hiking rates, and it was the same. It was the same statement at every meeting. I was there. I remember we were lulling ourselves to sleep. Forget about the markets. The Fed has definitely gotten a lot more communicative. I'm not sure they've gotten clearer. I think there have been some admirable efforts during sort of the Powell administration, if you want to call it that, to shorten up the statement a bit. They did take a paragraph out of the statement about the banking system in the last meeting, and I think the shorter the statements are, the less room for erroneous interpretation. And I think the press conferences, look, for better or worse, those are with us now. The Powell's predecessors were not doing press conferences at every meeting. Before Bernanke, there were no press conferences at all, and so it's hard to close Pandora's box once it's open.
So.
And I think
doesn't it feel like
they're not going back?
Doesn't it feel like a mistake? Like there's just so many different ways to interpret it. Like wouldn't it just be like you said it yourself? You said the Fed really can only influence the next meeting. So why are we even kind of trying to talk about SCP and talk about the dots and introduce these things that just confuse the market?
It's the desire for transparency is powerful, and I think that's why they've decided to do what they did. And they thought something was lacking in sort of the early to mid 2000s strategy as we were going into the GFC. But they certainly have added a lot of words to the mix. And the fact you have so many different Fed presidents coming out, and sometimes it feels coordinated, and sometimes it feels like everybody's sort of shooting from the hip and doing their own thing. But I find it interesting as sort of a Fed watcher. I'm not sure I find it helpful from an investment perspective. I mean, you see this much volatility in sort of the front month Fed funds futures contract is not, it means that something is lacking on the clarity front.
That's a great point. How you said it, as a Fed watcher, it's helpful. As a kind of a bigger picture macro, it's probably just muddying the waters. All right. Let's finish up with the 3 questions that we like to end with. First of all, what do you think is the hardest thing to do in trading or investing?
We have a chapter in MSD about behavioral finance. It encompasses a lot of things, but I think overall that the message is that there's a lot of emotion in investing, and the more you can recognize your own emotions, which create biases, the better an investor you'll be. And that could be everything from not wanting to sell a loser that's going to become a bigger loser, to following a crowd and wanting to be either part of the consensus, or sometimes our emotions or biases can make us want to be contrarian at a time when everybody else is saying one thing. The more you can take your emotions out of the process, and that means having a framework that you can stick to consistently, that you can apply when it's working well, but also when it's not working well. The easier it will be to explain to your investors what you did, but also the easier it'll be to replicate and have consistent performance over time. And just to take this example, I mean, we're quite bearish on the outlook. That's not something I want to happen, right? My emotions are telling me, we should hope for a more hopeful outcome, but our framework just doesn't point us in that direction.
That's a great point. I actually found a quote the other day from the 1989 Commodity Traders Almanac, and it says, "Remember, the market doesn't beat a player; it merely gives him a chance to beat himself." And I think that's so true. All right, Don Cox.
Very good. Sounds like golf.
Yeah, that's true. Don Cox used to say that you shouldn't invest on what is on page 1 today, but what is on page 16 on the way to page 1 tomorrow. Do you have any trades or ideas that would get the Don Cox seal of approval?
Yeah, so things that are out of vogue right now, it's basically our list of preferred asset classes. So because we use this interest rate framework, and we were constantly looking for not explaining what's about it, what just happened or what's happening right now, but what's going to happen. We're leaning into the things that have not been working as well in this equity market, which are ultra defensive stocks. I would say higher dividend yield stocks, because we're expecting interest rates to fall. So the things that people really don't like hearing about in meetings, like utilities, consumer staples, these are not the companies that are grabbing headlines at the moment at any given time. But we think those outperform the Magnificent 7 or 6 or whatever you want to call it, along with the cyclicals and certainly some of the bank stocks that we're seeing come under some stress. over the course of this year. And that, as we talked about earlier, also correlates with our outlook for long-term, high-quality fixed income, namely treasuries, which is another one of our favorite places to be.
All right, now let's get to the question that if EMH left you from last week. Here, I'll play it.
But if you had to move and live in another country for the next 10 years, where would you move to and why?
Hard one. Like I've assumed you've only lived in the U.S.?
I have only lived in the U.S. I guess given my choice, I would continue to live here, but the question presumes I need to move someplace else. I have 3 kids, and the middle one has a really hard to explain obsession with Finland. I think he learned it's the happiest country in the world, which immediately, if you're an 8-year-old, it's attractive. And all 3 of my kids are sort of this Scandinavian fascination. So I guess I pick Finland. It's probably not an answer that many people would give, but that's the unique family situation that
they're
is
lovely people. Lovely people. They eat a little too much fish.
You like fish, and that works.
Oh well, then it works for you. The one trouble is, if you had to live there, I would say just live there in the summer when the days are long, and not in the winter when there's almost no sunlight.
Oh yeah, we're watching a True Detective show on HBO. That looks pretty bleak. So.
All right. Do you have a question for the next guest that we can leave?
I do. Let's see. So this is something we think about a lot. So I'll ask it. So the question this week is, what is one misconception that young people have about the economy or the markets that you wish you could clear up with a snap of your fingers?
Oh, that's a great question. I like that a lot. All right, let's end with Ted Seides. Or no, it's actually not Ted Seides. I thought it was Ted Seides. It's actually Patrick O'Shaughnessy from his great podcast. He asked his guests, what is the kindest thing someone has done to you to help you along with your career? It's such a great question. I'd love to borrow it. Do you have a kind of an anecdote or a story you could share?
Yeah, and I think it's hard to think about the kindest thing without thinking about the kindest person that I've worked for. And I'll go back to my UBS days and mention a guy named Mike Ryan, who is an institution at UBS. He's still there. He's the vice chairman of the wealth business. He was the head of wealth management research while I was there. He plucked me out of a smaller group, added me to his team, promoted my work, got me in front of clients. And just, not everybody who is extremely nice can work in this business. Not everybody who works in the business is extremely nice, but he manages to do both. And he was a really, probably the person who helped me go from junior strategist, lowercase j, lowercase s, to somebody who could speak with more credibility to clients and could sort of develop my own views and have the confidence to express them.
Well, that's great. I'm glad. Hopefully he's listening and he's heard that.
Let's hope.
All right. So for people who want to learn more about what you and your firm are talking about, where should we send them?
So go to themacroinstitute.com. So we are rebranding under this single umbrella. We have Trahan Macro. We have the MSD, the Macro Specialist Designation, but the organization that's responsible for all of it is called the Macro Institute. One thing you can do right away is, even if you're not subscribing to the research, you can get our Macro Mondays newsletter email. Comes with a chart of the week and some thoughts on what's going to happen this week, and also illuminating what we think is going on in the world. So that's a great way to dip your toe into it and learn more about the MSD curriculum and learn more about our research.
All right. And they can find that and sign up for that at that URL?
Yes, they can.
Okay, terrific. Well, thank you so much for being with us. It's really a pleasure getting to know you and your firm. Is there anywhere, are you on Twitter or anything like that you want to also plug?
So you can follow Francois Trahan on LinkedIn and on Twitter, and he's the one kind of posting all the charts of the day and occasionally a rant or two. So that he's a good follow.
Sounds great. Thanks again.
Thank you.
All right, Kuppy. It's time to talk some charts, bud. And thanks for stepping in here for Kev.
I'm unsupervised here with Cap and Crayon.
Absolutely. All right, let's talk about the top 3 things we were watching, and the number 3 was the Mag 7 earnings. And to be honest, it belonged on this list, and it didn't disappoint. Like ultimately, there was some huge gaps. I mean, there wasn't any crazy misses. I mean, Apple did kind of drop on its earnings, but it really was that gap in Amazon and Meta that just keeps these Mag 7s just dominating the headlines. What did you take away anything from those earnings?
I mean, they're invincible. It's incredible. I I don't even know what to say. Like every day, Kevin and I, we just bitch about them going up every day, but the numbers are there. I mean, it is what it is.
Yeah. So number two, we were watching those jobs numbers, and while I was not expecting a spike in unemployment, I was not expecting the jobs numbers to beat this way. Like that. What did you make up from the numbers?
I mean, the economy is real strong. It's going to stay strong. When you're running like they are 7% fiscal and you're doing 6% nominal GDP, you'd expect the numbers to stay strong. They're going to stay strong.
All right, I'm not drinking the Kuppy Kool-Aid, buddy. You're on your own on this one. Okay, and the number one thing was the FOMC, and obviously the Fed just kind of tried to cool everyone's expectations down. And the interesting theory I've had, and it's not original. Other people have said this as well, was simply the fact that everyone has been pricing in the cuts so aggressively. They've already in many ways provided much of the easing that has done the job for the Fed, and therefore it actually, as a reaction, slows the pace from which the Fed has to act. And so, like, I'm not totally shocked that they pushed it back. I wouldn't even be shocked if they waited all the way until the June meeting or later to actually do the first rate hike. And so I'm not shocked by it. What did you take away?
I mean, I don't know even why they're talking about cutting. We're running a 6% nominal GDP. Like they should be raising rates and catching up still to 6. I mean, and I think inflation's kind of bottoming here.
Yeah.
I don't know why they're talking. They might do 1 or 2 cuts cosmetically, but the street thought they were at 8. I think the street's gone mad. I think they'll be raising before they do more than 1 or 2.
You think if they do cut, do you think it's politically driven?
I'm not going down that route.
All right. I literally threw you a pitch to see if you would.
No, Orange Man bad must stimulate.
All right. So let's talk about the top 3 things to watch over the next 2 weeks. And one of the interesting things, and you wanted to talk about it, we can dive right into it, is oil bottoming. And I want to just quickly pull up the chart on crude oil. And the interesting part is that after a very aggressive fourth quarter decline, where obviously oil, dropped
the 2-year.
Sure. But, I'll just pull up a weekly chart, so just farther out. But the thing, bottom line is that oil went through this 3-month decline, but really the last 2 months it stopped making lower lows. It really has started to find support, and so the interesting thing here is that are we going to finally see this being like one bigger kind of bottoming basing formation? I know you're the type of value guy that wants to get in early on these types of trades, and so like what's your take here? Do you think oil is bottoming, and are you starting to put this position on?
I mean, I'm the fundamental guy. I leave the crayoning work to you, but it does look like we made a bottom kind of, in the first half of last year. We started rallying and then they smashed the rally and we kind of retest that base level. And look, it's looking bid. I mean, from the fundamental side, we're supposed to draw oil in Q1. Historically, we've always drawn oil in Q1, and we're building oil. Time spreads are going in the right direction. Crack spreads are going in the right direction. It's all starting to look kind of bullish. I mean, I understand why the physical is rallying, and I think it's going to keep going now as we get into the rest of the year when we normally do have some draws.
All right. Well, listen, I want to actually take a dive when we get to the main charting section by actually looking at some of the energy stocks and some of the other things like gasoline. But let's just continue with the top 3 for a second. So the second thing I wanted to talk about is the breadth of the market deteriorating. And will that actually inevitably cause a market to begin some mean reverting correction after such a big run? And so like everyone on the surface is watching, the S&P 500, the SPX today, it looks like it's going to close above 5,000 at the time we're recording. So it's like headline porn for all the media agencies, popping champagne corks at the 5,000 level.
You got a hat ready?
Yeah, I do. Like it's a party like it's 1999, right? But uh, while the S&P has been running, the interesting thing is that it's not all the same. Like if you look at the chart on the equal weight S&P 500, it hasn't actually been able to beat its December highs decisively. And more importantly, the Russell put in its highs in December, and even just 2 days ago was actually trading near a 1-month low. The small caps are getting no love. And so what we're seeing is that these Mag 7s and a few of these big super cap stocks that are running are driving the market cap weighted indices higher. But underneath the surface, there's less and less participation. And one of the ways that I like to analyze that, Kuppy, is I like to look at the number of stocks trading above or below their 50-day moving averages. And this is the New York Stock Exchange as an aggregate. And what's amazing is back in late December and early January, we had 87% of stocks trending above their 50-day, which is basically what you want to see, which is a very broad participation. The tide is rising and all ships rise with the tide, right? It's like the market is healthy. But while the S&P here is making higher highs and continuing to plug to 5,000, we literally saw this come down to 50%. We basically now have literally 1 out of every 2 stocks on the New York Stock Exchange downtrending based upon the 50-day moving average way of measuring it. And so the thing is that to me, there's only one way this resolves itself. Either A, the breadth of the market will return, or 2, the momentum of these mega cap names will run out, and that will trigger a market correction. So which of the 2 will play out? Usually, it is the market that starts to correct, and the large caps, like the generals, are the last ones that run, and they're the last ones that turn. But it's something to watch. It's definitely what I'm watching. Any thoughts on that?
Well, I think I agree with you. You know, the overall market, the 493, doesn't really have a bid to it, and then the 7 stocks dragging everything up. It's not even 7 really.
Yeah,
it's just NVIDIA.
It's NVIDIA and Meta and a few of these other ones that are really going. And they by the way can keep going. Like there's nothing like you're the epic bubble rider of all of us. Like you know that when these kind of momentum things start, you got to ride them, because it's just like a feedback loop that just more money keeps flowing and chasing the same shit. These things can always shock everyone how far they go. And
yes.
So but inevitably, if the rest of the market isn't participating, they will ultimately reach an exhaustion point where they start to mean revert. And that's, typically when you see the, those 5 to 10% market corrections that always come a couple times a year.
I mean, I feel like Mag 7's draining the pool. It literally, all the capital is draining out of every QSIP, and it's really just going into NVIDIA. And everyone's going to their office in the morning and saying, sell everything in my book and buy more NVIDIA. And that's what's happening. It's draining the whole swimming pool of the market.
Yeah.
It has nothing to do with fundamentals. It's just you need cash to buy NVIDIA.
Yeah. You know what, though? It is interesting, though, when you look broadly, and we can pull up the charts in a moment, but the Nikkei and the Euro stock, there's a couple of these global markets that are actually on fire. And so there's definitely money flowing to some of these international developed markets. So this is really a U.S. equity story where the flows have been narrowing to the momentum chasing of whatever's been working, right? Anyway, let's move on. And the last point before we get is that we have the inflation numbers coming out. I mean, increasingly, the inflation numbers are becoming less and less relevant, because that ridiculous inflation surge we saw a couple years back has really dissipated. And while, there are those people that will say comments like reacceleration of inflation or the disinflationary forces coming, but to me, they're going to all be range bound. Like maybe we go towards 4% inflation, maybe we go back to 2%. But I think that where inflation was this boogeyman, that has come and gone for now anyway. And so I'm not so sure that these inflation numbers are going to move or surprise anyone.
I think inflation is here to stay. It's gonna, get up into the high single digits. It'll pull back. It'll get back into the high single digits.
You think we're going that high, eh?
Oh yeah.
But
Look,
you think in this cycle, like
oil. Yeah. I mean, look, the economy is really, really strong, and they're talking about cutting. Like, it's really stimulative. I mean, fiscal is still there. I really do think that so much is driven by the price of oil, and oil's got a bid to it now. And I think you're going to see your inflation numbers picking up throughout the year.
There you go. All right, you heard it here. Let's see whether Kuppy's right. All right, so listen, let's talk some charts. We talked about crude oil, but what I wanted to talk about is I often like to look at the correlation of oil to gasoline prices. And so here's just the continuous contract on the RBOB gasoline contract. And to me, this is even more bullish than the oil chart. And one of the thoughts I have is whether or not gasoline is almost like leading the way, and oil will follow. Like this looks like whether you want to call it a cup and handle, whether you want to call it inverted head and shoulders. We got a chart that has stopped its downtrend, started making higher highs and higher lows, and is ready to break out of the upper boundary of its last kind of 5-6 months of trade range. And it'll be if gasoline futures break 232.5 and get to 240, 250, I don't know how oil doesn't follow along on the way. And I'm wondering whether or not this is only reinforcing the idea that oil's ready to go.
Right. I mean, look, from the fundy side, we had a bunch of builds in gasoline, and the chart's coming up really nice looking, even with the builds. I mean, look at the 3-2-1 crack. I mean, that's been bid for a while now, and I think that's just reinforcing that there's real demand for products. Products usually lead oil, and it's just dragging oil up.
So I have two crack spreads we can look at. The first one is the RBOB Brent one. Let me just quickly put on a line chart so we don't have to look at the thing. But yeah, the crack spreads on this have been certainly improving to about the 16 level. And then I also have, this is the gasoline crack spread here, which is at $21. But basically we had that huge crash in crack spreads, and really since then they've been recovering. Obviously, while gasoline spreads have collapsed, there was still a huge margin on diesel spreads and other areas that basically made the refiners still make lots of money refining. But it looks actually. Let's talk about these refiners. Like obviously, Phillips 66.
They're all bid too.
Yeah. Well, first of all, Phillips 66 is marching to beat its own drum with the Elliott activist, got his fingers all over this one. But you look at the other plays. I'm just going to pick on Valero, for instance.
I mean, look at a 5-year chart. It's a big pennant it's building.
Yeah, on Valero?
Yeah, look at the 5-year.
Yeah, well, yeah. So you look
it looks
here.
like 150 sets it free.
Yeah, ascending triangle pennant, whatever you want to call it. The bottom line is that it's been in a multi-year consolidation, and if these things break out, they could be in full bull market mode on the upside. Nonetheless, the refiners look really solid, and so it's interesting. Like, would you chase a Phillips 66 that's already ripping, or do you play these Valeros and these PBFs? Like, do you have a couple of favorites in this refining space?
I think you just buy the one with the biggest buyback. I mean, PBF's the cheapest. Look, that one's already breaking out of the top of its pennant. Like, these guys all have big buybacks. They can't really drop because of the buyback. I think you buy the basket of them.
So yeah,
and you make like 20-25% a year every year till the day you die.
So listen, the best name in the ETF space has got to be the refiners ETF, which is symbol crack. Like
love it.
It's you can literally just buy a basket like this. I mean, obviously, I don't like the liquidity and the options on this ETF, so that's why I trade more of the individual names. But yeah, like look, there are these refiners. They look good. I have no pushback on that. For those offshore drillers, what was the story with Valero's dragging behind? Because I mean, Tidewater still looks really good.
Valero's looks really good too. Look at a 2-year chart. It looks like a big pennant.
Yes. No, listen, on a 2 year, like when you go on a long-term chart, it's been a primary uptrend, but it's been a very kind of sluggish 6 months.
Yeah,
And
I think everyone's wrong. I mean, I could tell you that I stood in there in the low 60s, and I basically made the chart. I made the bottom there. That was me standing in. I was a
I love it.
disproportionate percentage of that volume.
I love it. I love it. But yeah, listen, you know what? It's interesting because like when you look at Tidewater, that chart looks super healthy. Like even the entire consolidation has held, to Fibonacci zones, which is suggests that this is just a consolidation, which is within the ranges of where its previous highs were. This is a really interesting moment to see whether these turn bullish here. But you would lean into Valeris over Tidewater? Like, is that still
yeah. I mean, we made Valeris our second largest position. It's actually bigger than Joe, and you all know my crush on Joe.
By the way, let's just talk Joe for a second. You know, it's been obviously had a correction in the summer, in the third quarter of last year, but it's more or less holding within a stone throw of upper range of its area. You still got a crush on Joe?
Yeah, of course. I mean, it's our third largest position. The numbers keep coming out great. I mean, who's not bullish Florida? Like, how could you sell it?
There you go. Well, listen, just in the other parts of the energy space, obviously the majors like your Exxons and Chevrons, there was some acquisitions. They did some drops on some side. It was a sluggish period. But are you in any way thinking that these majors will turn as well? I guess they will certainly turn if the oil market turns. They're just like a natural place.
I think it all works. I mean, I'm not in the majors, but I think if you pull up XOP, which is, I guess,
the exploration,
mid-cap ones, and look at basically from March 2020, that's one of the sexiest looking pennants or triangles. I don't know what you chart people call this thing. I just call it a big consolidation that looks like it's about to, it's making higher lows, not really breaking out to the upside. It just looks like it wants to get going.
It's interesting because, like, for me, the energy space has been left for dead. And so it's kind of one of those scenarios where, well, look, if the economy isn't going to be as bad as all the bears believed it was, then how can energy not do well in that environment? At the same time, if the market does downturn, these energy stocks have already done such deep corrections that there's a defensiveness in owning them at these valuations. And, it's one of those scenarios where, heads you, I win, tails you win. Well, actually, I don't even know how to word that right. But the point is that it's one of those scenarios where I think owning energy stocks is certainly worth considering in a portfolio. It's to me, I think it's a good space to be in.
Oh yeah, I mean, look, I like that XOP chart. It really does look like if it goes above about 140, it breaks the top of the triangle and keeps going. But I mean, if that gets going, I think my Valeris is like, multi bagger. It's just it's one of the most torqued things I've seen in a very long time. I think they need to announce contracts for the 13 and the 14. They're two new drill ships, and then this has a couple $100 share price.
Awesome. All right. So let's, I'm going to circle back to some bigger macro charts. Let's talk currencies. Obviously, the dollar has been since the start of the year, more or less rallying. But to me, the biggest part of the surprise in the move has got to be the strength in the US dollar yen, which is literally a stone throw away from those October, November highs. Like, poor Kevin's been, touting his long yen position. It's been a tough road, but the interesting thing to me is, will the dollar actually begin another bull run? And I think that I'm not so 100% sold on it, but the way I look at it is it's a natural thing that if the dollar weakens off of this level, like, let's go back to this U.S. dollar index chart. If it weakens and heads for a double bottom retest of its support lines and things like that, becomes a tailwind for risk assets that can keep the markets juiced especially a little bit longer. Exactly. But, the one big thing to watch is what if the dollar surprises everyone by being stronger than expected? And that usually, leads to a lot of risk off kind of behaviors in the inner markets. And so, like, I think watching the dollar here is important on that. And so, well, let's see. The one thing I wanted to though talk to you about is the asset that shall not be named, but we can because
Kevin's on
not
vacation.
here.
We can talk
Exactly,
about it.
we can talk about. But Bitcoin, what a fucking breakout! Like,
Look, I don't know anything about this fundamentally. It makes no sense to me. They launched like 20 different ETFs that all seem to be buying these things. And when Wall Street corners an asset or tries to corner an asset, it goes up. And we had kind of a big move as they announced the ETF. And then, we had the sell the news, which I think is the most expected trade possible. And it pulled back 20%.
Yeah.
It has a bid again. And it actually has a real bid.
Yeah. Well, you know what? It is. And this actually fits the bill for a classic like flagging, wedging formation consolidation, which is a typical correction of an advance. And the thing is that if there's a saying that flags fly at half mast, which basically means that if this breaks to a higher high, the natural measured move is 60,000 on Bitcoin. And so it will be really interesting to see, does it break a higher high? Or, there's always a risk of a double top. It's something I would lean heavily into, but whenever something is retesting its previous highs, it's always a point where you're going to find out whether someone sells into it. But if they do break to a higher high, it'll be interesting to see whether this consolidation is the midpoint for a push up to 60,000.
Right.
Are you dicking around with this one, or are you just
I'm
watching?
Embarrassed to say on some. Please don't at me. I'm embarrassed. Just don't rub it in. But I'm up a couple of thousand already.
Listen, look, you're not going to be a bag holder. I mean, you're in for the trade, and
I'm not watching the YouTube videos about the halvening and getting all excited about it.
Yeah,
I'm definitely not doing that.
You're playing momentum like a trader does, and that's all cool.
If it goes up, you buy it. That's the rule of Bitcoin.
Now, I want to talk about copper because whenever Kevin's on this episode with me, he always shits on me for using the Dr. Copper analogy. And so I figure I can now use it since he's not on here. But like this copper is just sluggish here. And it's certainly, it's been a 1 year trade range between $3.50 to $4. And at this moment, with this breakdown, there's no reason not to believe that this trade range won't prevail for the first half of the year. We're probably going to base somewhere on the bottom end of the range and trade back to the top end of the range. And it's just going to be a ping pong match between support resistance. But are you in any way interested in the copper market's bigger picture, or is this just something you're
not in the slightest bit? I know everyone thinks it's going to be undersupplied, but I think it's going to stay balanced. I think people got way over their skis in terms of EV demand. And if you pull back the number on the EV demand, we have a balanced market in copper.
Yeah. Yeah. So let's talk about what everyone that knows you're coming on the show, they've been all waiting for us to talk about one thing. Uranium. Uranium.
Oh, the moonshot?
Yeah, there you go. So listen, obviously, the U308 down just below $100 at $99.50, but the Sprott Physical has still been in a phenomenal trend. A little bit of it was a kind of a heavy down day yesterday, but the prevailing uptrend is quite intact. During these kind of bubblish phases of things going parabolic, while you have these kind of nasty 1 day down days, I always try to tell my members, never judge the down day, judge the reaction in the days after the down day. And what I'm going to be curious about here is how quick and how fast do buy on dip traders come back? Because if this thing's back to $33 by Tuesday next week, to me, this was just a buy on dip, and this thing is just going to continue. At some point, or in just purely based on what markets do, there's going to be a washout event where they're going to throw this thing back 20% just to clip all the guys with trailing stop losses and all the weak hands that were overextended. But obviously, this is something that could be bullish for years to come. So how do you size up where we're at here in the uranium market?
I mean, look, the thing just doubled. It did it all in like 3 months. It needs to chop some wood. At the same time, I think the demand is really getting extreme from the physical buyers. I mean, ignore Sputs. Sputs just like this artificial thing that us retail traders screw around with. I mean, the real boys are buying physical, and there's a shortage, and all the producers are telling you they can't hit their own targets, and there was going to be a huge deficit before they all started missing. I think it woke up a lot of guys who are sweeping the book effectively. And yeah, 100's a big round number, and you're going to bounce around on either side of it. Sellers line up there, buyers line up around there. They just like the figure. But I feel pretty good that this is just a kind of consolidation, and then we get going again.
No,
I mean, I'm not sweating it. Look, my Twitter timeline is like 10,000 guys crying, and I'm like, what are you guys crying about? It's down $2 after going up 15. Like,
did you Did you at all follow the Cameco earnings? Is there anything you have a comment on?
It's a disaster. But it was very expected, right?
Yeah.
I mean, they don't really earn anything. It's a giant make work program for Canadians.
You're basically playing it through the Spud, right?
Right. I don't own any Cameco.
Yeah. Okay. So listen, is there a chart that I didn't put up that you want to talk about? Is there something you want to do a Kuppy
Kuppy special?
Yeah, a Kuppy chewing on crayons moment?
I don't really know. Let's talk about this NYCB. Okay, the bank that's been in the news nonstop.
Sorry, wait, what's the symbol?
NYCB.
Yeah, there you go.
And fair disclosure, whenever anything drops and implied vol goes past 200, I'm going to write some puts on it. I don't really care what the product is.
I love it.
And I told Kevin about this. I said at 250 vol, I'll sell Strangles till the day I die. And yeah, every once in a while I get clipped, but you get clipped on one or two of these, and at 250 vol, it's worth it. And we got a lot of Strangles. We got some straddles. We got anything you could sell. We have every option combo you can imagine. We got a little of it on.
What duration do you go? Do you usually keep it really short? I
don't think the bank makes it.
Right,
but short.
Yeah. So basically,
March and April.
Yeah. It's just a month or two, right? Like just Okay.
Yeah, I hope they can make it till Q1 earnings.
Do you think that this is reflecting on the fact that there's still things going on in the regional bank space that no one's talking about, or do you think this is just an isolated bank thing?
No, I think there's a lot of banks that did a lot of really, really stupid things back when interest rates were zero, and now they're going to have a comeuppance. And New York City Bank probably needs to raise a couple $2 billion to make it through this muddle. But that doesn't mean that 250 vol might be overpriced anyway.
Yeah, I mean, you're just a trader. I mean, that's just a trading move. That's
trader's going to trade, right?
Yeah, exactly. Like that, no one's going to judge you on that. Like it's the.
But I think it's interesting because I think put it this way: when Silicon Valley blew, everyone got spooked and freaked out, and now a year later, when New York City blows, everyone's just kind of like, "Man, it's isolated." It's a $100 billion asset bank. It's not small, but everyone kind of gave it a big shrug, and it just shows you. I think the markets got in blasé or just totally ignores this because banks don't matter to NVIDIA. And I think you're going to see a bunch of these come around where banks just fall out of the sky, and eventually I think the market might get a little worried.
There you go. All right. Well, listen, Kuppy, thanks again, buddy, for joining me. I had a lot of fun chatting charts with you, bud. So let's get this outro, and then we can shoot some shit at the end here. Hold on. So thanks for tuning into the Market Huddle. We appreciate you spending some time with us. And listen, you can never have too many friends, bear market or bull market. We're just happy to spend some time together on this crazy ride. So stick around for the after show. All right. First of all, Kuppy, I think, Danny, you can join the conversation here, buddy. And I just need to rate this beer. Now,
what'd you think?
You know what? It's not as poppy as I would have wanted the beer to be when I'm thinking blood orange. Danny, so Okay, first of all, Kuppy, what you got to know is that Danny now is residing here in Portugal. So he's down in the Algarve region, and where they have all of these blood orange trees. So he like came up to visit me in Lisbon, and he brought like this massive shopping bag of blood oranges that he just like ripped off of the tree. And then he goes and mixes up himself like a blood orange Paloma. And like I've been hooked, Danny. I've been hooked. Like, but now you make it with tequila, right?
Well, no, tequila mezcal, a little bit of agave, and then blood orange, touch of soda.
Yeah, so I was just using tequila. But listen, I've been hooked on it. So like for the last like 2 weeks, I've been drinking blood orange. So when I'm drinking this blood orange beer, I'm expecting the same punch as these blood orange Palomas. And the point is these are, it's kind of just a subtle blood orange taste compared to.
Maybe what you should do is get some of the juice, put it in the beer, see what happens. You never know.
Oh my God, that's a great idea.
Right. Also, if you want to level that up as well, have you ever tried tequila and beer together?
No.
Okay, right. So first of all,
have you, Kuppy?
No, it sounds good.
Yeah, tequila, beer.
I've had my share of
orange.
micheladas, but that's not quite the same.
Just put a shot of tequila in it, a little bit of blood orange, game changer.
Bam. What do you know?
Yeah.
Like, okay, we'll do that. You're bringing me another bag of that blood orange, right?
Yeah. I'll bring some more.
All right, listen, I'm actually not going to give this an overly high score. I'm going to give it a 7.2, and I usually use this. We never go under 5 unless it's absolute garbage. So I look at 7.5 as the midpoint. I'm going 7.2.
So was my statement at the start correct? It was awful, right?
No, it's not awful, but I'm not going to rush out to go and stock my fridge with this shit. It was interesting. All right. Anyway, hey, Kuppy.
Yeah.
You've been stranded on that island. How is island life? Are you going island crazy yet?
No, I love it here. It's great. Kind of bummed this week. There's a bunch of waves. They're a little too big for me. I'm kind of an amateur. I mean, they're 10 to 15 foot. I think I'll get murdered out there. But it's making me a little antsy. I need to get out in the water. But,
well,
it's great.
Right now, because I had numerous friends, including a nephew who's a huge surfer. He's 21 years old. Come visit me. And obviously, I'm 1 hour away from Nazaré in Portugal, which is
everyone wants to go watch.
Which is the world's largest waves. And so I've been going out there and just watching these surfers. It's freaking insane. Like I'm scared shitless watching them going up against these. Now, I mean, the record wave was like 110 footer, but these guys are normally surfing like 30, 40 foot waves. But fuck, like.
It's crazy, right?
There was I didn't see it live, but it was on the Instagram feed. There's like the Giants of Nazaré Instagram feed, and this one guy is just out there every day posting shit. And this one guy, the surfer, just gets crushed by like this 30, 40 foot wave. And they couldn't get him, and he's getting crushed by a second wave, then a third wave. He's just eating it. He disappears under the water for like 30, 40 seconds before he pops up again. And like, it's just insane. Like these, if you didn't have the Sea-Doos, you're freaking dead. They pull these out. Like it's insane surfing. Anyway, I'm like you. I'm an amateur.
I'm not doing that surfing.
Yeah, give me
4 footers.
Yeah, that was about to say 3 to 5 foot, and I'm happy. Like anything larger, it's like I've got caught in those those barrel rolls of the waves, and that's yikes. Like that's scary ass shit.
Yeah, it sure is. But when I'm not out there, I'm working my finca Kuppy. We started to harvest some bananas, so
Oh yeah. So tell me about it. How's it? You planted all those fruit trees and shit like that.
I didn't plant shit. Those were there. I bought a farm. Someone else had it 30 years ago, and then these gringos bought it, and they never went back once. And I got all overgrown. So I've just cleared out the vines, and there's a bunch of fruit trees there. I mean, I've only cleared out maybe like 2 or 3 out of the acres. There's plenty more work to do. If anyone wants an internship at Kuppy, please reach out. But no, I've cleared, and I found all sorts of fruit trees actually, just overgrown, and I think some of them are actually going to be okay now that I cleared the vines off.
Nice. Like, what kind of fruit do you have on there?
Oh, I got so many mango trees, I lost track. I have like 20 different varieties of mango. I have Canepa, I have Corazon, I got avocado. I don't know, I got all sorts of crazy stuff. Breadfruit, and I keep finding new stuff. I go out there with my machete and hack away at stuff, and I got this app on my phone, so you take a picture of the leaf, and it tells you if it's like a weed or you can eat it. And if it's useful, I'm gonna keep it.
Oh, that's awesome. That's awesome. I'm looking forward to getting a tour from you on that shit.
You need to come down here.
Oh yeah, no. Listen, I've been promising you for how long? I've come to see you in Miami, but haven't made it to the island. But it's on my to-do list, buddy.
Well, if you don't, I'm going. So
there you go.
Oh, yeah, come.
All right. Anyway, listen, Kuppy, thanks so much for joining us, stepping in for Kevin while he was gone, and looking forward to the next Kuppy's Corner when in the months to come, buddy.
Yeah, we'll do it. And when I got something to update, let's do it.
All right. Thanks, everyone, for joining us. Cheers.
Cheers.